What we knew in advance, of course, was that there was this 1 year momentum that stocks that did better in the last year tend to do better the next year, and we also knew that that there's sort of a reversal at the end, that there's a 1 month reversal. So usually when you measure momentum, you measure 2 to 12 month momentum because you cut off that first month. And so you want to. It's always been sort of the standard thing that you want to buy a stock that's done well in the last 2 to 12 month period, but ideally has not done so well in the last period because that's where there's a reversal. Now, what we're trying to do here is put this together and actually put the parts together. Why is it that you have a reversal at the short end of this, the last month, and why do you have a continuation in the period from 2 to 12 months. So that we already knew that there was something here to look for, and specifically though we hit upon acceleration as what to look for here, because if they basically have been going up, but going up even with a lot of jump to them toward the end, that means that they're likely to drop off. So this reversal effect is much stronger when they've been going up a lot. So the way we measure acceleration is we compare how much the stock has gone up over a more older period to a more recent period. So if it's going up much more in the more recent period than the older period, that ratio effectively is the measure of acceleration. Now we do this with exponentials, so we're weighting all the different periods, and the more you weight, the more the weight of the recent periods is doing really well compared to the older periods. Now you might think that's great. Of course, that's the naive view, that if it's going up, but even going up more recently, that's wonderful. But in fact, it's overshooting, and that's the acceleration. So if it goes up faster more recently than in the distant past, then in fact that's where the acceleration is, and it means you're doomed to a fall basically here. There's a practical impact here in the sense that people have been using momentum a lot. They, especially hedge funds, I will say, they're heavy users of momentum, particularly I guess even quant models of different types, because they like something that will predict a return. And everybody, like you hear such a simple phrase as "the trend is your friend," you know. And there's some truth to that with this momentum. But now we understand it much more, you see, because yes, the trend is your friend, but if the trend is overtrending, that's not actually your friend anymore. So once you understand the nature of this, because if we all believe the trend is your friend and we all follow that, we overtrend it, I guess, and these stocks become basically overpriced. Stocks that have had historically a big drop, and this is related, of course, to what I'm talking about here with these accelerating returns that have caused these big drops, but stocks that already have had the big drop actually tend to have the highest returns going forward. So tail risk, at least as measured by past drops, is a good explainer of future returns, better than the standard deviation risk by far, and actually certainly works in the right direction. We've also studied this and found that the tail risk, historical tail risk, is not such a good predictor of future tail risk, because investors really want to avoid that tail risk. Tail risk, by tail we mean a probability distribution. The tail is the worst part of the distribution. And people don't want that to happen to them, of course, because that's like a really bad result. And so people try to avoid the stocks that have this tail risk. And it turns out that the stocks that have had past tail events, that's not the best way to predict the stocks that will have future tail events. We can predict that with different models, really. And avoiding the past tail risk is not necessarily the thing to do, especially since the ones that have had the past tail risk, those are the ones that actually have the higher returns. It's sort of like you want to buy when there's blood on the streets. You don't want to buy, you want to buy when things really look bad. It's also true for the whole market that when the market is rising and then it really starts rising at a fast pace. I mean, I guess the extreme would be 1999, where everything was going up and then it just started really soaring up, and then you got the crash in 2000 essentially. So it does apply to the full market. It's just statistically not as strong because you only have a few full markets to look at. You don't have as much data when you look at the whole market as when you look at individual stocks.